As we speak, the US dollar has reigned supreme all over the world for our entire lifetimes, but times are now changing and America isn't as dominant as it once was. We all know it's still the largest economy, but its time in that position is running out as the rest of the world continues to grow exponentially, and over recent years times have changed and the US dollar is now under attack. Developing countries are forging their own paths, choosing not to be bound by Western standards of morality or right and wrong, and this is setting them on a collision course with the United States. But these developing countries all over have realized they can work together against the mighty American economy, and they've started down a path that is not easily stopped. We're watching a new form of economic warfare grow and expand, and it might just lead to the end of fiat currency, an end to the dollar as the global reserve currency, and a second renaissance for gold and gold-backed currencies, which could change our world entirely. This all started with the Russian invasion of Ukraine and the West's response. As Russian troops crossed the border and fired their weapons, the American financial system of the world fired back, and it tried to shut Russia's economy down. The Russian central bank had hundreds of billions of dollars worth of assets like gold spread out across the world, 10 billion in gold bars here, 20 billion in euros over there, and 30 billion in US treasuries somewhere else. But at the flick of a switch, suddenly it was all as if the Russians had nothing at all. The West instantly locked those assets up and passed laws sanctioning anyone and everyone they could, and essentially they stole billions of dollars from the Russian state and put Putin in a pinch. He'd been preparing for this war for a long time, stocking up on gold, oil, gas and various currencies, well aware that sanctions would follow his orders to attack, but he didn't expect the West to go this far, and it revealed just how much influence and control the West had over the financial systems of the world. So we see Putin fight back. He institutes his energy war in Europe and threatened to freeze millions over the winter, and he begun the process of propping up the ruble by forcing customers to buy Russian oil and gas with his currency and not theirs. This was met with resistance, as you might expect, and was by no means a slam dunk for Russia. Their financial markets are still shot, their replacement for SWIFT has been lackluster at best, and the strong performance of the ruble in the first few months following the invasion has been replaced with a slow and steady decline of the currency, as it's now fallen by 25% from its peak. What we see here is basically the West flexing their financial muscles, and the might is impressive, but it's also scary, and it's led to other nations that aren't immediately at threat to worry and try to plan against the United States just in case America decides to come for them next. Now, Saudi Arabia is looking back to the murder of Khashoggi and the US's disapproval, and they're wondering if they might become the next target. Brazil is looking around at the turmoil surrounding their recent elections, and they're wondering if their access to SWIFT might get cut off should their voting integrity seriously suffer. India is walking a thin line between authoritarianism and democracy, and if they drift too far one way, they may find themselves a target as well. And of course, China is watching the new Cold War brew with flashpoints every single month. Nancy Pelosi flies into Taiwan, Biden bans China's access to microchips, and a Chinese spy balloon flies over the US. So now the Communist Party is thinking that it's only a matter of time until this escalates further, until America fires the first salvo and begins the process of cutting them off from the dollar. So these countries have started to act. They've started to collude with each other and plot an end to the American-dominated financial system that dominates our world today. We've seen Saudi Arabia and China team up together to try and oppose this US dollar hegemony. They agreed to trade oil with one another and to price those oil deals in Chinese yuan instead of US dollars. This created headlines all around the world at the time because part of the US dollar's strength comes from the fact it is the petrodollar. Oil is obviously important for every nation, and we all know that, and for ease of trade, it's all priced and sold in the US dollar, which gives America an inherent global demand to its currency and allows it to print money at a far greater rate than any other nation in history. This was Saudi Arabia and China telling the Americans that they are not omnipotent and their shenanigans won't work on them. Of course, below the surface, this development wasn't as big a deal as the East would have you believe. This deal was only done really to prove that it could be done, and most oil sales between the nations have continued to be priced and transacted in US dollars, and those that were actually transacted in yuan have still ultimately been priced in dollars too. But China hasn't let the reality of the headlines hurt their ego, as they've been pushing this idea further, and in early December continued to urge Arab countries to trade their oil and gas in exchange for yuan instead of dollars. The real kicker though is that Russia, China, Saudi Arabia and a few others too have all been speaking with each other and considering establishing some kind of a shared currency that would be backed up by the natural resources which these countries dominate. Altogether, these countries would control nearly half of the world and its resources, and their currency would in theory dominate worldwide trade as well. And all the while this is happening, the dollar is at a crisis point. It's always been considered the most reliable currency backed up by the most reliable government, but that idea has started being questioned. The federal government's degree of debt is truly mind-blowing at $31 trillion, and it just continues to grow every single year, with not a single American politician doing anything to try and stop it. The government's spending got so ludicrously loose that inflation soared to a 41-year high, and there was only one possible course of action: raise interest rates. Under normal conditions, the US would be paying just under 2% to service this debt, which is already an eye-watering $600 billion a year, but when rates rise and stay high, that cost could easily double or even triple. The US dollar is powerful and stable because the US government is powerful and stable, but these things aren't looking so good these days, and that's where gold comes in, because it seems like it just might be the solution to these problems. We all know how irresponsible governments are with our money, inflating away what they allow us to keep with this silent tax, but if our currencies were on a gold standard, none of this would be possible, and maybe, just maybe, if these BRICS nations just pooled their resources together and ensured the continued value of their currency with gold, the rest of the world would choose it over the dollar. There's evidence to suggest that Russia and China are already working together when it comes to gold, with Russia supplying 67% more gold to China this year than the previous one, and the two countries being the largest producers of gold in the world. And what is needed to create the first gold-backed currency in the 21st century? Well, a very hefty gold reserve, of course, and both countries have been stocking up in recent years. Russia have already announced a partial peg of their ruble to gold, and Putin has also spoken about a new commodity-backed currency that's being created as we speak. Is it really so ridiculous to believe our eyes when the evidence is right in front of us? By all accounts, these countries want to dismantle the dollar as the world reserve currency, and they've revealed their playbook, and it all revolves around gold. At this point in 2023, we all know what the US economy is up against, with the last few years completely plagued by turmoil, tough market conditions, and stagnant or even deeply negative investments. Many people just don't feel comfortable buying the S&P 500 like they used to before the COVID pandemic changed everything, and this even includes myself. I personally sold out of all my holdings in US index funds back in December of 2021, over a year ago now, and it turned out to be the right decision. And now the US economy on the whole doesn't look like it's doing any better than it was back then. The Fed still isn't telling us they're going to pivot. We're creeping up on a serious deep recession, and some of the biggest and most influential countries in the world are building an attack plan to try and take down the US dollar. One of the biggest threats, though, is just the idea of stagflation that lasts for years or even a decade. My belief is that the US economy is going to flounder and struggle to actually tackle inflation, leading to multiple years of a stagnant economy and high inflation like we saw back in the 70s and the 80s, and honestly, a similar storm seems to be brewing across Europe as well. This document here outlines the similarities between the stagflation period of the 70s and today, and it's hard to note just how many there are. In the 70s, wars erupted and tensions flared between states, with the oil embargo of 1973 and the Yom Kippur War looking eerily similar to the Ukrainian war and energy sanctions we saw over 2022. There was a poor harvest in 1972, which led to rising food prices, and over 2022, news articles like this one predicting global famines from the Ukraine were commonplace as well. The Cold War was at its height the last time stagflation reared its ugly head, and today we seem to be slipping into a new Cold War with Russia, but more importantly with China, as they're growing more and more confrontational. In many ways, though, the situation is worse this time around too. The US government's budget deficit was merely 5.7% at its worst point in 1983, whereas it reached 15% in 2020. Debt to GDP measures were far safer back then as well, with corporate debt sitting at around 50% compared to 77% today, personal debt sitting below 50% whereas it's sitting above 75% today, and state debt rising from 35% in the 70s all the way up to 123% today, and that's without even mentioning the ridiculous debt burden hanging over the federal government that we're all aware of. The economy is not looking strong at all, but gold, and more specifically one gold mining company presents us with a real opportunity to protect our investment. Back in the 70s, bond yields were losing money every single year to inflation, but gold prices were steadily rising. An ounce of gold would have set you back around $35 in 1970, but by 1983, when stagflation was finally over, gold was worth over $400 per ounce. And on top of that, gold mining stocks performed far better than most other assets at the time as well, with a total return of 364% over those 11 years shown. But today, many people look at the price of gold at all-time highs and they wonder if they're too late, and that brings me on to Gold Mining Inc., today's sponsor. They're a nicely listed gold mining company with the ticker symbol GLDG that presents a huge value opportunity for investors worried about stagflation or inflation going forward. Now, Gold Mining Inc. own 32 million ounces of gold equivalent resources, or essentially gold in the ground, and the company is currently only valued at around $190 million US. If we take away the company's $77 million in cash and their shares in other companies to get their free enterprise value, that means each ounce of gold is valued at around $4 when you buy GLDG shares. Now, for comparison, deals in 2022 between gold miners were signed for $25 to $30 per ounce, which means that if the company wants to sell these resources today, they'd ask for over $800 million. And when you take into account the other shares this company owns, its fair value is actually around $1 billion. This also lines up perfectly with analyst expectation like those over from H.C. Wainwright & Co., who value the stock at $6.25, about 5 times the current price of $1.15. There's also about a 5-fold difference in the current market value of the company compared to the actual intrinsic value of the resources it owns. As a result of this, when gold goes up in value, Gold Mining Inc. increases by even more in value, adding leverage to these shares as opposed to just simply buying gold. From December 2013 to March 2014, gold rose by 11.49%, but GLDG rose by 164%. From January 2016 to September 2016, gold rose by 22.65%, but GLDG rose by 665%. And from December 2018 to February 2020, gold rose by 26%, but GLDG rose by 150%. The data really speaks for itself, and this company is poised to perform really well, as is gold, over the coming years, and it's got an incredible team behind it as well. Gold Mining Inc. was founded by Amir Adnani, who also founded 2 uranium miners, Uranium Energy Corp and Uranium Royalty Corp, both of which have risen by over 200 or 300% in value over the last couple of years and garnered huge attention for being some of the best performing stocks around. Amir's other companies also outperformed dramatically during bull markets, with Uranium Energy Corp rising by 1035% since March 2020 and 189% since June 2021, and his other company rising by 875% since March 2020 and 153% since July 2021. He clearly knows how to run mining businesses and manage the systems which make these companies successful, and the board is made up of some of the biggest names in gold like Rick Rule and Doug Casey. At its current price point, Gold Mining Inc. is just plain and simply massively undervalued, so for me, it's just the best place to get exposure to gold at a time when it could be entering a brand new heyday. It's listed on the NYSE with the ticker symbol GLDG, so check it out and have a look if you've been thinking about gold but aren't quite sure about buying it at its peak price. This is the alternative for my portfolio, and it could be for yours too.